Hello and welcome. We are in the thick of earnings, and in between all of those, we're going to try to squeeze in SBFC Finance. Now, it's interesting because it's an NBFC firstly. It trades at around 3 times price to book. And when it comes to the ROA and the credit cost, it's held up very, very well. Even in terms of growth guidance, there's been no concern as of now. And that's why in this cycle, this one becomes very interesting to understand. Let's first understand as to what I want to really look for when I'm trying to analyze this one. Can the credit cost and asset quality sustain? Currently, NBFCs are seeing pressure, a lot of them, with regard to asset quality. This one is not seeing too much pressure. Even in terms of credit cost, you're not seeing too much of that impact coming on the P&L, and therefore, can that sustain? Because that will lead to likely better growth outcomes. And that's probably my second point here, to try and understand whether there's a downside risk to that 5 to 7% QOQ growth guidance. So very, very strong growth guidance. Can that really sustain is my second question. My third question is with regard to increase in leverage, and why I say this is because the capital adequacy of SBFC is at 35%, which means that it has a sizable amount of equity within that capital base that it has and that it disburses from. And therefore, it has good bandwidth to take on borrowings onto its balance sheet and reduce its capital adequacy to grow. So they will now likely start using more and more of borrowing, which they've already been doing. But as they do that, their capital adequacy will come down, but their interest cost will go up, and therefore their margins will come down. And therefore, in such businesses, better to look at spread than margins. But as the margins squeeze, does the ROA, which is the return on assets, which is a measure of profitability, does that also come down? So that is the other piece that I want to look at. And last off, cost efficiencies. Its cost to income has come down from 50% to 40%. And therefore, what you're seeing is a better profitability, which is coming through. Can that continue, and to what extent? So we'll try and bring out all of these points when we have a chat with the management. But that's the first piece of it, what I want to know. Now I'll come to the fact as to what the company does, because that's what we do on KYC. We try and break this company down. We'll first start off with what the company does. It was incorporated in January of 2008. It was incorporated as MAPE Finserve Private Limited, renamed to Small Business Fincred India Private Limited on the 3rd of July 2017, and then called SBFC Finance Private Limited from the 24th of October 2019. It converted into a public limited company on 30th of September 2022, and thereafter listed on exchanges on the 16th of August 2023. It raised around 1,000 crore worth of capital, and it is co-promoted by Clermont Group and Upwood Group. Now, in terms of product, it includes MSME loans, secured MSME loans, and gold loans. So loan against gold and secured MSME. Understanding is 100% of the book is secured. We'll obviously get better perspective as to what the risk could be in case of default. How long does it take for them to liquidate some of these assets, if at all there is a default? It also offers, and this is where it becomes interesting, loan management services to third-party financial institutions, particularly in Tier 2 and Tier 3 cities. It's known to have a good process in terms of loan disbursement and loan collections, and it leverages on those. It operates through 205 branches. Branch count has increased by just about 10 or 15, so around a 7%, 8% kind of branch count growth over the last year or so. And it has around 4,294 employees in 16 states and union territories. So good, large presence as well that it has. In terms of its key milestones and what it really likes to boast about, one is it first off acquired Kavi's lending book at 845 crore. That was what happened. Now, on top of that, it also had between 2017 and 19 adopted the phygital model, which is combining technology with in-person customer service. They in no way continue to push digital only. They are very much physical plus digital. They converted to a public limited company for their IPO, of course, and they listed in August of 2023. The IPO price was 54 rupees a share. They listed at a 44% premium. And currently, the stock price sits at around a 25%, or has given 25% returns from the listing price as well. So decent amount of returns as well that the stock has given. But let's quickly look at the key metrics and what we'll try to break down in terms of giving the KYC rating that we do on this one. We'll start off with the income statement. We'll thereafter look at the balance sheet, the operating metrics. We'll look at asset quality. We'll also look at the shareholding pattern thereafter. We'll look at valuations, street cred, and street coverage, which we generally always do. So broadly, that's how we'll try and cover all the bases. I'm going to first start off with income statement as we do. And, it's a fairly healthy setup here. You look at the way in which your net interest income has gone up. It's gone up from 250 crore in FY22 to 777 crore in FY25. Very, very strong growth on that net interest income number. Also, the NII has grown faster than the AUM, which is again a very healthy sign. Provisions are up around 27% at a compounded rate, and profit after tax is up a very solid 74%. OPEX, as I did mention, is one of those reasons why your profit after tax has seen a bit of a surge, along with scale and economies of scale playing out with regard to the business. But that's how the numbers stack up. A clear thumbs up with regard to how the income statement has shaped up. The balance sheet, last 3 years, very similar, strong balance sheet that we've seen. AUM has gone up from 3,100 odd crore to 8,700 odd crore, which is a 40% growth YOY, and compounded for 3 years. That's very, very strong. Look at the capital adequacy. It's gone up because of that fundraise that they had in the middle of 2023. So that has led to an increase in capital adequacy. Currently sits at 36%. Again, very healthy capital adequacy. Now let's look at operational metrics, and this is where some of the details start to come through. So you had ROAs which were sub 4% prior to listing, which is FY23. Thereafter, it crept up to above 4% and continues to go up. Can it sustain is the question again. Margins, which were at around 9.5%, have gone up to 10.2%. I did mention that you could see a margin shrink because interest costs could go up. We'll quiz management on that, but that's a risk, and therefore we've given this a neutral, whether that ROA number can sustain or not. Spreads have also gone up from 7.5% to around 8.5%. OPEX to assets has come off sharply, and we spoke about this as well. OPEX to assets has come down from 5.5% to 4.65%. Whether this can continue to shrink and how much scope is there for that will be one of those questions which will likely determine how ROA shapes up in that second row. So that will hold the key. But that's how the operational metrics, setup is. We've given this a neutral, and of course we'll quiz management on how this plays out. But let's look at asset quality, and this holds the key from a perspective that you look at the stability on that 2.6, 2.4, 2.7. So you're seeing very little variation in that sense, at least over the last 3 years. You're not seeing some major concern there. And you look at net NPAs as well, and that is also fairly robust, 1.6, 1.4, 1.5. That's how it's played out. You look at the last 3 quarters journey as well, 2.7, 2.7, 2.74 on the GNPA count, and on the net NPA count, 1.6, 1.6, 1.5. So fairly steady in that sense, but not necessarily a space where asset quality will continue to remain steady. You want to continue to watch out for this metric. Don't have a very large history with regard to this one, so you want to wait and watch. A neutral on this count because you want to be conservative where asset quality is concerned. Shareholding pattern. Now, in terms of how that has evolved, look at promoter holding, 53 to 54 odd percent, fairly steady in that sense. FIs hold around 5 to 6 odd percent, 6.5 odd percent. Apologies. So yes, DIs hold around 17.5 to 17.5ish percent, and the public shareholding is roughly 22 to 23 odd percent. That is how some of the shareholding has evolved. We've seen a bit of inch up in terms of FII holding over the last quarter or two maybe. And within the DIIs, you have SBI Small Cap Fund, which is featuring, and you have AB Sun Life Fund, which is also featuring with regard to this one. You also have Franklin India Smaller Companies Fund, which also features. Among public holding, again, very interesting, you have an Amansa, which holds around 3.8%, but has been very, very mildly reducing its shareholding by around 0.01%. And you have Asim Dhruv, who's the MD and CEO. Again, interesting, because Asim Dhruv is ex-HDFC Bank, the current MD CEO of SBFC, who holds around 3% in the company. And then you have Malabar India as well, among others, which holds around 2 odd percent. So you have some interesting shareholders as well within this basket, and a thumbs up with regard to this one. Mind you, the market cap on an SBFC is 11,000 crore. So something to keep in mind in terms of the shareholding and how much of the market cap gets derived from some of these promoters and how much do they own. But let's look at valuations now. And we've kind of compared this to a Manappuram from a perspective that it gives you some flavor with regard to gold lending. But gold lending is a very, very small composition of the overall loans of SBFC. It currently trades at 3 times 1 year forward price to book, which is certainly not cheap by any standard. Credit Access is a pure play MFI, which trades at around 2.2 times, but it has its set of asset quality issues. So again, may not be the best comparable in that sense, but we'll give it a neutral with regard to where valuations is concerned, not the cheapest on the street. Let's look at street cred. And in that sense, it's done okay when you're looking at the street credentials. Again, since listing, it's not given a significant return from the listing price. So if a shareholder had bought at IPO, they've made decent amount of money, but post-listing, we're not seeing a very substantial rally in the stock price, just about a 25% fair return. And for a small cap, that's still quite decent, given the way in which some of the small cap indices, or rather the benchmark, has done. Let's look at street coverage now. Last off, you have 4 buy calls, 1 hold call, 1 sell call with a potential 15% return. Surely a thumbs up with regard to that. You have a decentish kind of coverage and a decentish kind of return expectation on this one. But that being said, let's quickly move on. It's time when we go across and speak with the management. We have Mahesh Dayani, who is the Executive Director at SBFC, joining us right away. Mahesh, good speaking with you. Thanks for coming in. I want to first talk about the fact that what are you seeing on asset quality trends, and what are you seeing with regard to how your asset quality is evolving at this juncture? Because several NBFCs are facing asset quality headwinds at this point. Your book looks relatively okay. Talk to us about that.
So I think you'll have to differentiate between various asset classes. So you've got largely secured and unsecured, and the conversation is largely related to retail. Unsecured, obviously, has been going through some bit of turmoil, and a lot of noise and a lot of warnings were placed sometime last year. What you're seeing currently is basically the outcome of what excessive lending had happened over these years. And if I were to talk in terms of priority or in terms of quality, I think MFI was the worst hit, followed by unsecured business loans, personal loans, credit cards. So you have a commentary which isn't too positive, but incrementally what you see is that largely the unsecured or some bit of credit card, the stress seems to be easing off, still not out of the woods, but incremental stress seems to be easing off. MFI, I guess the stress is still there. And that's what, when you look the quarter four results, that's what really comes out. If you look at secured, I would say most of the players in the affordable side have reported a reasonable, stable quarter. We've been no different. Last year, we had paused our disbursals, so we didn't really have a significant jump in disbursals, but that was being cautious right at the beginning of the year. The numbers, the bureau numbers that were coming out weren't too great. So we took the foot off the accelerator way back then. And what you're seeing the numbers now is just largely on account of prudence in terms of the disbursals that we did last year. The way we look at it, I don't think significant change has happened at the leverage level. But we're a small company, so to commit our momentum, whether it's on dispersal or the asset quality moving forward, isn't too difficult. So we've always maintained that our delinquencies are going to be range bound. Credit costs is going to be somewhere around 1%, 10 basis points here or there. And the NPAs are also going to be pretty much range bound. So that's some degree of solace if you're completely a secured lender, either by property or gold.
Sure, point taken. But what gives you that confidence, Mahesh? Because while you are secured, I take that point, but you still lend to the MSME space.
So I think one of the key things is that we're well diversified across the country. So we've got almost an equal contribution from all zones. So you don't really are clouded under an event risk. So an event risk in a Karnataka or a Tamil Nadu or any other state that may happen really doesn't impact us. It doesn't take the wind away from the momentum that we've been building. And because a concentration risk is limited to at best 8-10% in a single state, we wouldn't really see us getting stuck in an air pocket for a fairly long time. If there is a particular event, at best you're probably impacted by a month or two, but it really doesn't disturb your apple cart significantly. So that gives us the confidence saying that unless and until obviously you have a large event which impacts the entire country, then it's a different thing. But some spurts here or there is obviously not going to rock the boat too much.
Okay. And is there a specific cohort? Is there a specialization of the type of borrowers that you lend to, Mahesh? Because again, that credit cost number of 1% which you are targeting, and maybe 10 basis points here or there, I'm trying to assess, judge what's the downside risk to that.
So, if you go back even during COVID times and you look at most of the bureau numbers, the highest delinquency that's gone is anything between 4 to 5%. And I'm talking about roughly ticket sizes ranging anything between 1 lakh to 30 or 40 odd lakhs. And even if you have an LGD of, say, 30 odd percent, slightly higher, your credit cost is not going to completely go out of the park beyond 1.5 odd percent, or probably nearing 175. So that's the worst possible outcome when your entire country is shut. You don't have the ability to lend, you don't have the ability to collect. That's the worst possible outcome. So even if we were to look at that kind of a scenario, we're saying that your standard deviation is almost 2 times from where you are, which is very unlikely to happen. So even if you look at any cohorts and you probably cut down data to events which are state specific or pan India specific, you're pretty much range bound on a secure lending side. So whether it's home or non-home, so you will have a particular range to play. Obviously, your efficiencies and your ability to execute comes into play, and that's what probably shows up in our numbers and the guidance that we've been given.
And Mahesh, the security that you take, one is loan against gold. What are the other assets which you give loan against? That's the first part. The second part is, in case of default, how complex, how complicated, what's the kind of time lag for you to make that recovery?
So in terms of properties, you rightly mentioned, gold obviously has the gold as the collateral as the security. With respect to properties, almost 85% is residential property, largely self-occupied. You have close to around 7 to 8%, which is commercial, and the balance is a bit of a mixed use kind of a properties. Answering your second question, with the time that it takes, if loans do qualify under SARFAESI, then you have a fast track of resolution that could range anything between 18 to 24 months. If those are outside of SARFAESI, then it could go to 36 and 48 months.
Understood. And what's the risk like on growth, Mahesh? Likely the only risk is the fact that you could have an asset quality slip up, but that you seem to be confident of that. And therefore, this 5 to 7% growth, how long do you expect this to be sustainable for QOQ?
I think the only risk is going to be our own stupidity of not executing it well. I don't think we're going to go down because of the market not being large. So the market's almost at 3.5 lakh crores, growing at almost close to 21 odd percent. And that practically means that you double every 3 to 4 years. So I don't think growth is a challenge. Uh, how well do we execute it? How well do we execute it efficiently? How well do we execute it without burning too much of human capital, financial capital, and remaining profitable at a branch, at a unit level? I think that's what probably keeps us awake. I don't think there's an overhang of growth. And that's the reason what we've always maintained, that growing at 5 to 7, which means that you're annually growing anything between 25 to 30, doesn't seem to be a challenge on a segment which is a priority for the economy, for the regulator to grow, even not for the next 1 year, but obviously for the foreseeable future as well.
Sure. And what does, of course, you'll be looking to increase leverage, right? You're at a 35% capital adequacy. What do you expect and when do you expect your next fundraise at? Is there a thought process there? 20% capital adequacy, 25%? What's the kind of bandwidth you leave? And therefore, as your debt goes up, explain to us where your margins will normalize at.
So currently we are on an ROA basis closer to 4.5% odd. So practically at a leverage of close to around 3, our exit ROEs are closer to 13 odd percent, slightly more. So we have some degree of leverage which is available. I think our first milestone is to hit 15% in terms of ROEs, which should probably happen by the end of this particular financial year or the first quarter of next year. But that's something that's been consciously designed to go in. Because our ROAs are high and we keep on accruing profits on a year-to-year basis, we don't see ourselves going back to the market at least for the next 8 quarters. Clearly, I think the first of these milestones have to be achieved. Adequate return has to be delivered on the business that we're delivering before we go ahead to the market. On a debt to equity, we're barely less than 2. I think we have enough room to take it to 3.5 on an operating basis, considering that the rating upgrades that we've had consistently, obviously subject to our operating performance. We don't see a challenge going up to the leverage of 3.5 times from where we are.
Point taken. And therefore, where should your NIMs and ROAs normalize at, Mahesh? How should one look at those numbers?
So I think instead of NIMs, one has to look at spreads in a business. So largely what it means is that at what you lend and at what you borrow, and that brings in the efficiencies. If you're really doing well, your rating is on your side, so your borrowing cost technically should keep coming down. Ability to lend at the right price is important, whether transmission of interest rates happen and happen on time. That seems to be very critical. So what we've maintained is we will continue to maintain our spread, and that's been our narrative all through. Some minor basis points here or there, but largely our spreads are going to remain constant all through the year. So we don't see that changing,
and ROA, Mahesh, therefore, and cost efficiencies and their impact on ROA, how much more can you optimize OPEX?
So what tends to happen is, we swallowed the frog upfront and took a higher cost at the start.
Sure.
And so what you would see is a downward sloping curve with respect to our OPEX. So we've been always maintaining that our OPEX should start seeing a downward towards almost 50 basis points a year. Last year, I think, did well on that count where the OPEX came down by almost 70 basis points. This year, we continue to maintain the same trajectory that our OPEX is going to continue dropping by 50 basis points. So if you do the maths, if we continue our efficiency run and we are leveraged to 3.5, so your ROE impact is 50 basis points multiplied by 3.5. So that gives you almost 165 benefit on your ROEs. And that's what gives us the confidence of hitting a 15% ROE by the end of the year or the next first quarter of next financial year.
Point taken. Thank you so much, Mahesh, for coming in, speaking with us. And of course, it'll be good to track this through FY26 as well. So looking forward to our next conversation as well.
Thank you.
But that's the management of SBFC. We've spoken about pretty much all that we had to. We're going to quickly look at the ratings on our KYC rating with regard to the parameters. That's how it stacks up. Good growth on income, balance sheet, operational metrics fairly healthy, but we've cautionary given it a neutral. Asset quality neutral as well. No major changes on any of those counts. Shareholding thumbs up. Valuation neutral given that it's quite steep in that sense. Street cred neutral and street coverage thumbs up gives it a 6 out of 8 on our KYC ratings. But we're out of time on this edition of KYC. We hope you found this helpful. Stay tuned, more action on the other side.